Good morning and welcome to today's webcast, Trump's Plan, a closer look at the tax and economic impact. Before we begin the presentation, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Welcome again, everyone. Thank you for joining us, and I'm pleased to introduce today's presenters. Gary Stirbis, Director of the Tax Controversy and Dispute Resolution Practice at Moss Adams LLP, and John D. Carvalho, Chief Investment Officer at Moss Adams Wealth Advisors. And during today's presentation, we will be covering Trump's tax plan, Trump's economic plan, and we'll have time for a Q&A session at the end. Gary, I will turn the line over to you to get us started.
Good morning, everyone. First, I want to thank everyone for taking time out of their day to listen to what I think is a very interesting topic, a highly debated topic, and that is tax cuts, tax reform. Obviously, we had a very contested election in this country, and anytime there's a change in party and a new president-elect, it's a ripe time for tax cuts. If you go back and look historically at Reagan, Bush, Clinton, they were very poised to pass tax legislation, and everyone agrees that's one of the main issues with Trump's tax plan. One of the things I want to talk about, though, and be very clear is that, this is just a proposal at this point. The House has also put forward a proposal that I'll talk about some of the specifics associated with that. And then I want to focus more on Trump's tax plan in general. One of the things that's really difficult when you go through something like this is how do you stay objective? And if you look at a lot of the information out there, there's news articles, there's newspapers. Some of them are very conservative, some of them are very liberal. So I found one of the best and most objective analysis of the tax policy of any candidate is the Tax Policy Center, and that is the foundation for much of this presentation. And the Tax Policy Center is basically, it's a joint venture of the Urban Institute and the Brookings Institution, and it's a non-for-profit Washington think tank. And for over the past 10 years, they've kind of analyzed different candidates' tax plans. They do a bipartisan analysis and look at the different policymakers and disseminate that information. I think it's a very good approach to analyzing this. So if you want more information as I go through this, you can go back to the Tax Policy Center. They do probably 40, 50-page analysis on both Trump's tax plan, also the House. And again, these are projections, so I want to be very clear that at the end of the day, these are proposals, and what we really want to do is see how is this legislation going to play out. It's probably going to be a hybrid of what Trump is proposing, what the House is proposing, and there's going to be a lot of debate, but it's still very interesting information. So, if anyone watched the presidential debates, there was a lot of controversy about Donald Trump not releasing his tax returns. Should he pay more tax? Did he pay more tax? Should he have paid more taxes? And if I was one of his writers on his campaign, one of the things I first thought about was Judge Leonard Hand. And this says, no duty to pay more than the law demands. And he was a very famous appeals court judge that never made it to the Supreme Court. Many people thought he should have, but this is from a very famous case called Gregory v. Helvering. And it says, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will be best pay the Treasury. There is not even a patriotic duty to increase one's taxes. So, as a tax professional and a tax practitioner, I firmly believe in that we don't have a duty. There's a big difference between tax avoidance and tax planning. And so what we do is we look at these proposals, these different things that are out there, and then we try and do planning. And so what I want to do is really highlight what the potential cuts could be, what the potential reform could be, and then how that would impact individual taxpayers. But it's a very interesting quote. I'm not going to read the second one. It's there for your own information. But these are very famous cases that really discuss tax policy. So the big picture when you look at Trump, and again, I wanted to emphasize that the House has very similar approach in a lot of these different cuts, but I want to highlight those. I'm going to discuss a little bit about what the House is proposing as well. And then at the end, I'm going to summarize what the House actually does. And at the surface, Trump certainly plans to reduce marginal tax rates by a very significant amount. I'll talk about this as I go through this subsequently in more detail, but that's one of the major provisions. The House is actually planning to do exactly the same thing when it comes to marginal tax rates, but they differ on some of the other proposals, most importantly, corporate taxes. He also wants to increase the standard deduction to a much larger amount, repeal certain personal exemptions, put some caps on itemized deductions. One of the biggest aspects of his tax plan that's a revenue changer is decreasing the corporate tax rate and decreasing the rate on pass-through entities. John, who's going to talk later, is going to talk more about the economic impact. I'm going to talk a little bit about the impact on revenue and distribution, but he's really going to dive into the economic analysis. And there's certainly an argument that the biggest benefit goes to the highest income households. But again, that all depends on what would or could be passed. So it's still speculative at this point. If it was passed in its entirety, though, overall revenue would go down by $6.2 trillion over the next decade. And so one of the aspects of that, this does not address really reform in the sense of curtailing incentives, credits, things of those sort. It's really what are the impact of the overall cuts. And so that some have argued that is somewhat understated. Does this simplify the tax code? I think in certain ways it could, especially when you're reducing marginal rates and increasing the standard deduction. But anytime you have a change or a revision to the tax code, you are going to create new complexities. And that's in reporting. That's how things are supposed to be analyzed, how they should be treated. And so you're going to have simplification in some ways, but also new complexities. This is a little bit of a busy slide, but it's pretty simple to break down. And that is currently we have 7 tax brackets ranging from 10% going all the way to 39.6 for the very top rate. And what Trump is proposing is to simplify that down to just essentially 3 tax brackets at 12%, 25%, and 33%. And at the top end, that would be a 6.6% cut on the very top end. And what's interesting about the House, they've actually proposed the same change in the marginal tax rate. So when you're looking at just marginal tax rate changes, Trump and the House kind of have a very similar approach to that. The other thing that he wants to do, and this is a very significant approach, and that's increasing the standard deduction to $15,000 for single filers, $30,000 for joint filers. And if you look in at our kind of overall our society, most people itemize because of mortgage interest, especially if you look at middle America. That's the biggest deduction that they have. And by doing this, the projections from the Tax Policy Center is that out of the 45 million people that actually itemize, 27 million would be able to take just the standard deduction. So 60% of the people that itemize, if the standard deduction changes, would certainly simplify their tax reporting provisions. So that honestly, that is, I would be considered definitely a form of tax reform and simplification of the process. A couple of other key provisions on the individual income tax side, that is repealing the head of household. The argument against that, though, is if you're a single individual or have a large family, it could actually negatively impact you even with the marginal tax rate cuts. It just depends on which bucket you fall in. And, that's kind of what you call the marriage penalty. The other thing that he proposes is capping itemized deductions, and that is about $100,000 for single filers and $200,000 for joint filers. Obviously, you're talking about a larger or smaller segment of society that has those types of itemized deductions. But again, that's one of his proposals. One of the other things that he's talked about, and both the House agrees with this as well, is repealing the alternative minimum tax. And without getting into the nuances of the AMT, what it is it's the best way to describe it is it's kind of like a corollary tax system. It was originally intended for those that have significant deductions and a lot of deductions. And the tax code creates these preference items that can kick you into the alternative minimum tax. The problem with that, it's never been indexed for inflation. So annually or every time there's new tax legislation, there's what's called an AMT patch. So instead of trying to index that for inflation, he wants to repeal that tax in its entirety. The House also has that same approach. So this is an arguable slide, I would say, because one, we don't know what the legislation would be. But the biggest benefit would come to the highest income taxpayers if the legislation is passed. Overall, if you look at the tax cut, the average tax bill would go down by roughly $3,000. The number is $2,940 based on the projections. You can certainly round because we don't know that would be, but taking an average is kind of a hard way to look at it because everyone falls in a different situation. But if you look at the top taxpayers, the top 0.1%, and those are people with incomes over $3.7 million, they would see a tax cut of $1.1 million and an increase of over 14%. And the top 1% would see essentially a 13.5% increase. So that always begs the question, well, what really is the top 1%? And this number certainly varies, and it's bandied about in different ways, but generally you'll see that someone that's making over $460, $470 of adjusted gross income falls in that top 1%. So if this legislation was passed, they would certainly see a benefit of this. And again, if you look at the House, though, they're kind of proposing the same cuts when it comes to marginal tax rates. Where they differ from Trump is on their approach to corporate taxation, which is in reality probably the biggest tax cut in the Trump proposal. But before we get to corporate tax rates, I did want to discuss a little bit about capital gains taxes. And this is, again, when you think about legislation. Candidate Clinton wanted to actually make some changes to capital gains tax based on holding period. What Trump wants to do is kind of keep them the same. Honestly, I think this is somewhat of a busy slide as well, but what it would do is keep the same preferential capital gains tax structure that's in place. But anyone that's watched the news or read the news clearly understands that one of the first things that they want to do, and it may come actually before tax legislation or subsequently thereafter, or very close in time, is repeal of the Affordable Care Act and the ACA Act. And that included a 3.8 net investment income tax that really piggybacks on the capital gains and dividends. So if the Affordable Care Act is repealed, the net investment income tax would also be repealed. It doesn't have to work that way, but it's certainly the approach that he is pushing. And so the net investment income tax, again, also hits people that are generally making over $250,000 AGI for a married couple. So if this changes, that would be a benefit to that segment of society. But again, the legislation has to be passed. The House also is making that same proposal to cut the net investment income tax. And I think what we'll probably see is repeal the Affordable Care Act prior to a tax act, but nobody knows for sure. The other thing, if you watched any of the debates, was a big discussion about carried interest, and that there would be either an amendment or an abolishment of the carried interest. I think there was a lot of confusion and misinformation about what carried interest actually is. Really, that is a capital gains tax, and what it did, it gave a preferential rate to specific money managers, private equity managers, to actually take what could be considered wages as a capital gains rate. And so it's what I call a rate play. It actually hits a very small segment of society. Subsequent to being elected, there's been some discussion that for certain money managers, they would certainly have to take income into wages at ordinary income rates, but there may be a benefit to private equity funds because they have more risk-based capital, and they might actually get the capital gains rate. No one knows how that'll play out, but at the end of the day, I call it almost a red herring because it's a small segment of society. It doesn't impact a lot of people. So estate tax. Estate tax is, I think, a controversial tax in that it's a transfer tax. It's not an income tax. A lot of people don't understand that, but to simplify, certain estates, if they get over a certain threshold, over $5 million for an individual, over 10, almost $11 million, for a married couple doing some very basic planning, until you're over that threshold, you're not subject to estate tax. But the policy argument against it is those people that have accumulated those estates have already paid individual income tax probably on that accumulation of wealth. They may have paid dividend or capital gains taxes, so why should they be taxed again? And so what that does, it causes a lot of people to spend down their assets over time or to give to charity in order to get below that threshold. And so when it comes to estate tax planning, I always tell clients, well, why do we plan? And we plan for estate tax or even estate planning in general because we all love somebody. And that sounds somewhat funny, but really it's about giving the assets we have to the people we care about. And if we don't have any heirs, often it's charity. So that's what estate tax planning is all about, and it causes people to spend down. But who it impacts tax-wise is actually a smaller segment of society, and the cost is actually pretty small in the whole scheme of things when it comes to income and corporate taxes. So what he wants to do, which is Bush actually was able to accomplish this, is actually eliminate the estate tax, gift, and generation skipping transfer taxes. I think the argument against that is that, okay, that's very much an incentive for the wealthy to spend down their estates to give to charitable entities. And the concern, I think, for charitable entities is, would our contributions go down if people don't plan for their estates? And that's a policy discussion. That's not for me to say here or there, but that certainly is a concern. So would there be other provisions that encourage charitable giving? That could be a compromise in eliminating the estate and gift tax. So business taxes, I think this is certainly one of the biggest elements, and John will get into this in significantly more detail because it's really a strong argument. We have one of the highest corporate tax rates in the world, and John, I know, will put up a slide a little bit later that I think shows we fall in the top 5 in the world in our overall corporate tax rate, which is 35%, and Trump wants to cut that back to 15%. That's a very, very significant tax cut. One of the arguments, though, about our corporate tax rate that really isn't as high and as effective as other countries because we do have a lot of credits and incentives. And so if you look at one of the criticisms of Trump's plan is it's not necessarily tax reform, but it's really just a tax cut. Whether that is reform, that's for individuals to decide, but it looks more like a cut because it doesn't address incentives, credits, things of that sort. Other kind of big change is he would have the owners of pass-through entities could elect a flat tax rate of 15% on all their pass-through income. That's certainly a big shift. And I think one of the issues and one of the criticisms both for the House plan and Bush's plan is what that does, that incentivizes people to go out who would normally be maybe just wage earners to create a partnership or an S corporation, argue that it's a valid trade or business, and then take income into that to shift from ordinary income rates to a flat 15% tax rate. And as a tax professional that does a lot of tax controversy, a lot of interaction with the IRS, One of the issues is the IRS doesn't have a lot of resources right now, so an enforcement of that would be a very difficult proposition. But certainly that would be an incentive for people to form a pass-through entity to minimize and get a better rate play versus ordinary income to go at flat rates. And the House proposal also plans to do that, but at a higher rate, and I'll talk about that in one of my last slides. The other thing he's also talked about is allowing corps and pass-through businesses to elect to expense investment in equipment structures, inventories, rather than getting into a more complex depreciation regime, which there's a lot of incentives for different businesses, different types of depreciation. That would give a time value of money benefit that certainly is all based in all tax planning. And then the last thing would be repealing the corporate AMT and certain business tax expenditures, but it certainly looks more like a tax cut. Emily, it looks like we have a polling question here, if I'll turn it over to you.
All right, thank you. Our first polling question is, Trump is proposing tax reform, and your options are true or false. I'll give everyone a few moments to respond. To participate in the polls, please click the button next to the answer that you choose and hit submit. And I'll go ahead and close it down. Let's take a look at the results.
Oh, it's a very interesting result. So the argument is there is no right answer here, and that's the lawyer answer I'm going to give you. But the reality is if tax reform is tax cuts, 80% of you believe that's true. Some people think it's false. I think that's certainly just an argument. There is no right or wrong answer here, but a lot of the analysis and policy decision makers said reform is more of like going to a consumptive tax or addressing incentives. But at the end of the day, if taxes are reduced, that's certainly 80% of you believe it's reform. So there is no right or wrong answer there. I've already talked about the ACA taxes or the Affordable Care Act. Obviously, if you watch the news, that's one of the things that Trump wants to do is repeal that in its entirety. Currently, there's not even a penalty for no insurance. I mean, there is a penalty, but it's not enforceable. So the IRS could apply the penalty, but they actually can't collect. The biggest aspect of that, as I discussed, is a 3.8% net investment income tax. Some miscellaneous provisions, that's the new deduction for child and dependent care expenses, increasing the earned income credit, some tax-favored saving account benefits. Those are all smaller dollar items that I think are very much favored, pretty easy legislation, not a lot of impact on revenue. So I think those would probably be easy to pass. So another polling question, Emily, I'll turn that over to you.
All right, our second polling question is, Trump's tax plan will impact which of the following? Federal tax revenue, individual income tax distribution, the tax code, or all of the above? And as a reminder for those of you that would like a copy of today's slides, you can download them now from the folder that says Slide Deck and Handouts at the bottom of your screen. We will also be sending the slides and webcast recording via email after the webcast. I'll give everyone a few more seconds to make a selection. And let's see what everyone has to say.
All of the above, that's absolutely true. I mean, I think we've discussed that pretty clearly. That it's going to have an impact on all three of those items. So what I wanted to kind of highlight now before I turn over to John is kind of the impact on revenue, distribution, et cetera. I've already talked about this, but if you look at revenue distribution, if there's no other changes, there'd be a $6.2 trillion reduction. That doesn't account for interest costs or the macroeconomic effects. But what actually 3/4 of that revenue loss would come from the business tax provisions versus the marginal tax rates. The rest would be individual tax rates. And you can see, as I discussed earlier, repealing the estate and gift taxes actually has a smaller overall impact on changing the revenue picture. There's an argument that national debt impact is understated because none of these projections take into account interest costs. Now, if you look at the impact on distributions, again, this legislation has to be passed, and I think it's going to vary. It's probably going to be a hybrid of what actually comes out. But overall, taxes would go down by about $3,000 for the average taxpayer. But, it really depends on what bucket you fall in. But the top 20% or quintile gets a 6.6% increase in after-tax income. And you look at the Tax Policy Center's analysis, they really break it down in this 20% brackets. In contrast, those at the lowest threshold would only receive a little less than a 1% increase, and middle-income household would receive about a 2% increase in their after-tax income. Now, we talked a little bit about the complexity. I think the biggest changes would be going to a larger standard deduction, reducing the record-keeping requirements, the reporting requirements. Significant 60% of the itemizers would drop out. So anytime a tax reform, I think there's a couple issues. It's one, there's an incentive for high wage earners to form a pass-through. How would you enforce that? And then I always talk about there's going to be changes from a tax planning, there's tax software changes, there's education, and there's explanation. And then I say misinformation, because I think one of the worst things or traps people can get into is hearing something they see on the news or a proposal and making decisions based on emotion versus logic. And I think that's our job as tax professionals, to say, okay, what really are the provisions? Let's make informed decisions versus doing something based on one proposed legislation, or even as the legislation is passed, let's make sure we understand it before we engage in tax planning, purely based on something we might read in the news. But I want to cover the House proposal real quickly. I've talked about most of these provisions. They also want to go from 7 to 3 marginal tax rates. They're increasing the standard deduction. It's smaller. It's from 12 and 24,000, so it's less significant. They want some preferential treatment of capital gains to 6, 12.5, and 16.5%. I discussed repealing the NIIT, and then we're on the corporate tax rate. This is the biggest change. They're proposing 35 to 20%, more consumptive and incentives to do certain behavior, which is very different from the Trump plan, and then a top rate of 25% for all pass-through entities, and again, repealing the Estate, Gift, and Affordable Care Act. But because there's a smaller provision on the corporate rate, the revenue decrease would be $3.1 trillion, which is almost $3 trillion less. And at the end of the day, I like to kind of end with this slide because I think it's what in reality will happen. I like this. It says, laws are like sausages. It's better not to see them being made. And that is, all legislation involves compromise. And oftentimes passing laws talked about making sausages because there has to be compromises. So we don't know what will actually happen. But I wanted to leave you with this one thought. And that is, I mean, we have a great country and we had great leaders. And we have a separation of powers. So no matter what happens, the elected president cannot pass all the legislation. You have the House and the Senate, and then you have the judiciary, who can certainly interpret that legislation after it gets into place. And so James Madison made this comment on the separation of powers in the Federalist number 48. And it's just such a great quote, I wanted to leave it with you. And that's: an elective despotism was not the government we fought for, but one in which the powers of government should be so divided and balanced among the several bodies of magistracy as that no one could transcend their legal limits without being effectively checked and restrained by the others. And so what he's saying is all the different branches of government will balance this out. So don't lose sight of logic and do things based on logic when it comes to tax planning. And with that, I think it's a good transition to talk about the macroeconomic effects. So, John, if you want to take it over.
Thanks, Gary. I always like listening to you talk because you actually make a really exciting topic like tax code even more exciting. So thanks for that. I appreciate it. But in all seriousness, Gary, I really learn something every time I hear you speak. So what I'm going to do today for everybody, and thank you all for tuning in, by the way. It's a very good, interesting topic. I think that 2016, if we got a lesson out of that, was really to expect the unexpected. As we enter 2017, I think this globe, not just here in the United States, but we're in a period of transition. And I think that how we adjust to this transition and uncertainty is really going to define a lot of the next 4 years ahead of us. So what I wanted to do in just some organization is give you insight into some of the immediate impact that the election of Donald Trump had on the marketplace, give you an overview of the economy just that he inherits, and then give some high-level elements of what the term that the market is called Trumponomics really entails. So with that, I think we'll just go on to the first slide here, which is shows you consumer sentiment. If you look at the consumer sentiment slide, you'll see a spike in the monthly number here. This was right after the election. We have now surpassed the pre-crisis high mark of 2007. Consumers reacted very positively. A lot of this has to do with the individual tax cuts that the market is already sort of pricing in and assumes that we'll get. So consumers being already, they were already quite strong. I mean, it was a little bit of volatility, but maintaining the level above 90, right around 100. And now we surpassed that. So consumers are very confident heading forward, and that should be a good sign for the economy because 70% of our economy is made up of consumption. The next slide here that I'm showing you is small business optimism, and the index rose 7.4 points in December. This is coming off a gain of 3.5 points in November, which was really made right after the election. So now we're at the highest reading that we've had since 2004, which is 105.8. What is driving small business optimism is corporate tax cuts, which, again, the market is assuming that we are going to get, and we'll give you a little bit more detail. Gary already went into some of the detail that the Trump administration is expected to propose, and I'll just give you some insight on why this helps small businesses. The other aspect that should help small businesses is the expectation of deregulation. So we'll have a less onerous regulatory environment on businesses going forward, which is a cost. There's a cost associated with that. So that's why small businesses are very positive as we move forward. Now, taking our attention to the economy that Mr. Trump inherits, you'll see that the gray line is really where the financial crisis was. That's the gray shaded area, sorry. That shows how deep that recession was, the deepest that we've had since the Great Depression. And as we've come out of it, there's been volatility in terms of the growth, and it's really been anemic growth. We've had fits and starts. You know, last quarter we got 3.5% quarter-over-quarter growth. But for the year, when you look at year-over-year growth, it's 1.7. That's subpar. It's below 2%. And people are asking themselves, well, what did we get for all the money that we've thrown at the problem in the financial crisis that we're only growing at 1.7% year over year? I think this has really been sort of the motivation for the Trump administration and some of the messaging that he has proposed, and it signifies change for the people. And I think that's what really powered his campaign and got him elected into office, is that people see Mr. Trump as being able to institute real change is really what people are looking for. I think that's the message that we got out of it. If you look at inflation expectations, this is the reason why we look at this is inflation at a modest level is good. It signifies demand is growing and that companies can increase their pricing power, and consumers will pay that amount. So far, our CPI right now is sitting at 1.7, but as you look in 2016, even before the election, before the outcome was known, future inflation expectations were rising already. I'll speak a little bit about what was driving that and why we've seen inflation expectations go up quite dramatically last year, and where we expect CPI to go as well. If you look at, and CPI, sorry, acronyms is a thing here. It's the Consumer Price Index. So this just is a basket of goods that shows price changes over time is really what it is, and that's the signifier for inflation. If we look at the actual inflation number, the green line is the headline number. This includes food and energy. The red line excludes food and energy. You can see it's much more stable. We expect the green line, the headline number, to go to roughly 2.5% this year in 2017. And that's a good thing because one is that, again, it signifies strength in the economy, that companies can have pricing power and pass that on to the consumer. It's also good in the sense that we have increased our national balance sheet, so you want to have some inflation so we can sort of inflate some of the debt away. over time. And right now we've been at very modest levels of inflation. You can see even going back to 2015, we had a deflationary scare going into that year, and we've come out of that now. And deflation is no longer a concern, especially with the Trump administration. The policies that he's talking about has been perceived as an inflationary policy. Again, coming off of very low levels, this should be a good thing for the market, and that's why it's being received positively. With inflation, anytime you have a sustained inflationary environment, usually wage growth needs to be there. So right now, we're sitting at 2.5%. In fact, the latest number that just came out pegged in wage growth at 2.2%. So we had a slight decrease in that number. The average over the last 20 years has just been below 3%. And the average rate of wage growth when the Fed would start hiking interest rates was actually at 3.5%. So we're still at a full percent below, yet the Fed has embarked on a interest rate increasing policy, which has really driven the dollar higher. But so we see here we're still below all measures just in terms of economic strength that we have, and this is sort of why we're looking at these policy changes as being a positive to the marketplace here. That's what the market's interpreting. So talking about inflation, we don't have wage growth, so why have inflation expectations gone up? Well, it's really been powered by owner equivalent rents. And owner equivalent rents is what we use within the CPI to show home prices and sort of where housing is. So this is a very convoluted chart, so I kind of want to take some time to explain it. If you look at the red line depicts household formation. Sorry, I beg your pardon. The yellow bars, the columns, that is household formation. The red line is housing starts, and then you have the CPI in the black line there. So what you see here, what is interpreted, is that you have household formation far outpacing housing starts, which is why rents over since 2014 have gone pretty much straight up. That's the owner equivalent rent portion of the CPI. So when you look at it, we are nowhere near where we were pre-crisis in terms of housing starts, and household formation was much lower. So we have a significantly greater number of households with less housing starts, shows rents going up. And actually, we think that rents are probably going to continue to go up as we move forward because of this shortage in housing. And this is why inflation expectations, the main reason inflation expectations have gone up. You can also add into that oil stabilizing, and oil is probably going to be, forecasted. We forecast oil to reach about $60 a barrel. Right now we're trading at about 50. So the full year we think we'll get to $60 a barrel on oil. And those are the two factors that are really driving the headline number. Everything else like durable goods, automobiles, they're really not going up in price too dramatically. So these are the two components that you see driving inflation. So that's the economy that Donald Trump inherits at this point in time. So what is he proposing in terms of his economic policy that has got the market so positive? And here's the elements there. We have lower corporate and personal tax rates. He's also looking at repatriation of cash. We've got a pro-business regulatory environment, which is really deregulation. We're looking at more lenient fiscal policy, so fiscal spending to support the loose monetary policy that we had in previous years. However, we are going into a tighter monetary policy environment. We're talking about the Fed increasing interest rates. We've got a little bit of runoff now on the national balance sheet, which doesn't mean they're tapering if you recall quantitative easing, when they started to get out of that program, they started to taper their purchases. Now we're talking about runoff on the national debt, which means they're not going to reissue that debt. So we'll see how that works here with Mr. Trump's administration coming in. Because Gary alluded to some of the national debt figures, and I just want to hit on that just briefly. The CBO, which is the Congressional Budget Office, has a forecast over the next 20 years. If you did not increase spending and you did not lower taxes, our national debt load would reach $45 trillion in 20 years. At $45 trillion at the current interest rate environment, we would be having interest expense at roughly $750 billion a year. If you normalize interest rates to more of the normal level, you're talking about $1.5 trillion in interest expense. This is longer term, and anytime that you look at the long term, it's very uncertain. There's a lot of things that could come into play that change that. But these are the concerns as you look towards the outer years. But like I said, there's a lot that can change in those outer years that could affect that picture. So the forecast is only as good as what it is today, which is really an uncertain environment. We are facing a lot of uncertainty with the new administration, and what Gary said is legislation still needs to be passed in a lot of these areas. So what we're looking at is trying to give you an overview on what we're expecting. I'm going to go into taxes first, but I'm not going to hit on the personal tax rate side. And the reason I'm not going to do that is because there is quite a bit of debate about what cutting personal or individual taxes would do for the economy. In the near term, I think it strengthens the consumer picture. But coming in 2016, we had already a broadening consumer base, which means more of the middle class was participating already. In this country, half the country pays taxes, half of them don't. So there's been a debate about what the effect would be on cutting individual taxes. What's the marginal benefit for top income earners? Do you get the marginal benefit from owning that fourth car or putting in another swimming pool? That's the debate that goes on the personal side. On the corporate side, I think it's a little bit clear what we're looking at. And in the near term, which is this year, the statutory legal corporate rate, and I just want to make a difference between statutory and effective. So you'll see it says 39%. On a federal level, it's 35%, but we're adding in 4% for state and local taxes just to get to right around 39% to give you an idea of what the legal corporate tax rate is in the United States. The effective tax rate is actually when you take into account their deductions and strategies that they can use to minimize the actual tax that's being paid. So, for example, on the S&P 500, you're looking at a median tax rate of 28%, which is slightly, more than 10% below the legal rate when you look at it. And it's right there for you to look at. So you go back to 1975, we had corporate taxes of roughly 48%. The effective rate was 44%. We're all the way down to 28%. So the big thing here is what do corporate tax rates get lowered to, and are they going to be able to keep the strategies in play to make the effective tax rate lower? That's the question. We anticipate, yes, they'll be able to keep those strategies in play. So what can we expect in terms of the corporate tax rate to get to? Well, as Gary alluded to, in the United States, if you took that 39%, we have the highest corporate tax rates in the developed world right now. So you look at 39%, and why would it make a big deal if we were to lower the corporate tax rate down to 15%, where Trump is proposing? And really where we think things go is right around that 25% level. You can see the House Republican proposal initially was 24%. I believe Gary said they revised it down to 20%. Pass-through entities would be taxed at about 25%, I think it is. We think that there's a good likelihood it comes in at around 25% is what the compromise is going to be. So let's use that level to work off of. If you're looking at a corporate tax level of 25%, you're thinking the effective tax rate can go down from that level. So this just goes over what we just spoke about, lowering from 39 to 15. This results in hundreds of billions of dollars falling right to the bottom line. And that's why the stock market has moved higher, even though you've heard a lot of talk about overvaluation, is because earnings haven't adjusted. The earnings expectation has not adjusted to what corporate tax rates could be cut to. So that's why the market will move higher. And the overvaluation that you're seeing right now may not be as high as if earnings estimates go up from this level. This is what is driving the market higher. So again, let's just take that 25% as a level that we can expect corporate taxes to get cut to. If you look at 25%, then you're thinking that, okay, well, let's say we get to keep the strategies in play and the effective tax rate actually gets to 15%. This would impact earnings by roughly 26% in this year, the current year, 2017, in comparison to 2016. So you take a price-to-earnings multiple, which depicts valuation on the market, And let's use 18 as the multiple. Currently, we're trading at 19. So let's just take 18 as the multiple. On a full year earnings picture, at $133 per share, you're looking at roughly $2,400 on the benchmark S&P 500 as a potential target. That is roughly 5% higher than where we're at right now. So that is what is driving the market higher at this point in time. So when you take a look at that, you can see why people are pretty bullish on 2017 in terms of performance coming out of the domestic equity market. With that, I think we're going to come to a polling question, and I'll turn it over to Emily to answer that.
Great. Our third polling question is, are true or false, corporate tax cuts could benefit the market in the short term? I'll give everyone a few moments to respond. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. This is our third question. And let's take a look at the results. John, back to you.
Great. Sorry, true was 97%. Great, yes. So I did a good job in explaining why corporate tax rates would benefit the market immediately. So here's just an idea of how far the market's gone in a very short period of time. Since the election on November 8th, and I produced this slide on Friday last week, the S&P 500 has gained 6% since that period of time. So it's a very bullish sentiment. The market is sort of pricing in the most optimistic scenario here, that we do get corporate tax rates. We think there's a very high likelihood that corporate tax rates get cut, especially when you have a Congress that's Republican-controlled, along with the administration being Republican as well. That said, there will be compromise, and not everybody's going to go along with what the administration plan is. So those are a few factors to keep in mind. Moving on here, I wanted to talk a little bit about the repatriation of cash overseas. So this basically entails corporations that operate outside of our borders. So U.S. domiciled corporations that do business overseas, they don't bring back the cash from overseas. And there's debate on what the estimate is, but we know it's in the billions of dollars. So right now, if they were to bring that cash back, it would be taxed at 39%. Now, Trump has proposed 10% tax rate on repatriation of cash. It's uncertain about whether we lower the rate going forward or whether there's a one-time tax holiday. So what we did was we looked at what happened the last time we had a tax holiday on repatriation of cash and what the effect would be. When you look at this, 2004 was the last time that we had the tax holiday. 158% of corporations authorized buybacks. Basically, when they bring cash back from overseas, their companies put that money to use through purchasing their own stock back. This, again, has a very positive effect on earnings per share, because what you're doing is you're shrinking the number of shares of your company available for trading. Naturally, the earnings per share goes up from that level. So again, we haven't even accounted for potential repatriation of cash, shrinking the number of shares available for trade, which could then boost the level of the domestic equity market again. So there is some debate about how we do this, because the goal is really not to allow companies to bring cash back to the United States so they can just buy back their shares, which doesn't have an economic lasting benefit. The thought process is that there are those that want to have stipulations on the repatriation of cash coming back, meaning that we will incentivize corporations to invest in their companies, hire people, put that money to work that is going to have a benefit economically going forward. So not just buying back their stocks, which is really just a one-time benefit, boost earnings per share. It doesn't really do anything to create value within that firm. So that's what the debate is about, how we allow companies to bring back money, but get them to put that money to work as well. So the other factor here that is really playing into the bullish sentiment in the market is a less restrictive regulatory environment. So the pendulum in regulation seems to swing to the extremes. We have very low, regulation at one point that really led to the financial crisis. Unbridled greed took over, and we just didn't have any, check on what was going on, and you get into this situation where you have the financial crisis manifest from itself. Now, the pendulum has swung so far in the other direction that there's a high cost to regulation. So the thought process here is that if we deregulate, and mainly in the financial sector, banking will be positively affected. There's less cost there. They'll start to lend money more, and credit would increase. And credit is really the grease that helps the economy and the economic engine keep going. So given that this has been the slowest recovery in modern U.S. history, it's easy for people to say, boy, less financial regulation, it's going to be a significant factor in getting this economy going. So the whole process here in terms of lowering taxes and deregulation is really centered around getting growth high enough that because we're cutting taxes, we'll actually be able to collect more in aggregate tax dollars at a lower tax rate, and then we won't be adding so much debt to our balance sheet because the economy is accelerated beyond that point. So that's the thought process here on deregulation, and really the argument that they're talking about is that it's not just for the financial sector, it's for all sectors of the economy that the cost would be decreased. You're talking about agencies like the FDA, the FCC that would deregulate, and the thought process is that it would be optimistic, it would expand margins, revenue and earnings would accelerate as well, and therefore growth would increase. The big concern, again, getting back, is this could lead to another wave of this destructive crony capitalism that led to that financial crisis. But, that takes a long time to manifest itself. So we're looking at the short term, and things this next year, if we do get some deregulation, could be very beneficial. Another topic that's got a lot of press has been the infrastructure plan that was talked about during the campaign. Now, Trump had detailed an infrastructure plan that was really drafted by two economic advisors, Peter Navarro and Wilbur Ross. Wilbur Ross is a billionaire, and this could include up to $1 trillion in spending over the next decade. However, the difference between Trump's plan and Hillary Clinton's plan was that Trump's plan relies heavily on private funding. So this sort of resembles the European structure that they have there, which is to privatize some of the infrastructure that we have there. The good thing about this is it really brings the private sector into play, which is generally better at managing costs and overruns. And it also goes into being able to help the transmission mechanism of any federal funding that would get behind it. So they're really looking at providing tax credits to projects with a dedicated source of revenue. So you're looking at toll roads, airports, ports, some utilities. Utilities less likely than the toll roads and airports. But these would be the cost to build it and to increase those projects would be offset by the fees that would be paid for the user. So this does have some merit to get going. It's just a question of how do they implement this plan, and really what does its final form look like. Overall, though, it should be beneficial to the economy as we get workers in there that would, you're losing revenue from the government through the tax credit, but the argument is that because we're employing people, we're able to collect tax from employing more people and those workers back in the workforce there. So that's the offset to it. The last thing here I wanted to touch on was some of the potential trade restrictions, which was a big deal during the campaign. This is a very divisive topic. And as we've seen early into Trump's public life as the president-elect, he's already established sort of a pattern on how he intends to impose these border trade policies. So he's not really focusing on individual nations specifically. He's really looking on U.S. domiciled countries, looking to move production of goods overseas. And he's really sort of like threatening them with tariffs and regulation on their products that they would bring back to the United States to sell to the U.S. consumer. So, he could still impose tariffs on goods entering the United States from specific nations, but that looks really a lot less likely now than it did during the campaign. But again, this is all very uncertain and things could change. So with that, I think we're going to enter into another poll question, and after that, I'll just bring it back to summarize everything that we've talked about.
All right, our final poll question is, true or false, we can rely on everything that is said during a presidential campaign? I'll give everyone a few seconds to respond, and once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification icon at the bottom of your screen. I'll wait just a few more seconds here to give everyone a chance to weigh in. And let's go ahead and take a look at the results.
Yeah, I think this was a free one for those looking for CPE credit here. Obviously, we've learned over the years that campaign promises sometimes get followed through, sometimes they don't. That's just a very diplomatic way to put it. But I think what Gary talked about is that all this that we've talked about, there's a lot of uncertainty. And how things get passed in their final form remains to be seen. But we have an overall roadmap of where we think things would go. Now, there's always room for surprise, but at least we have a direction. And I think the most important thing is to have a plan that you can adjust to. So that's really what we have here. If we went into it saying, well, let's just see what we get here, we would have to react at that spur of the moment to what's happening. So I think the big takeaway for people that are listening here and that are running your business, I think that 2017, we're very constructive on this year, and we think it could be a good year. And that's really in the short term. But, you know, prudency would say that we want to be prepared for the longer term, even when things are going good. It's like that old, you know, the grasshopper and the ant type story is that, you know, you just don't want to play all day when the sun is shining. You want to make the preparation for when the winter comes. And I think that's the big thing, is because there is a lot of uncertainty about whether this plan gets the economy going forward. So be prepared for a good year, but I think look to the outer years on where things could really change for the positive or for the negative. And really, we don't have a crystal ball, otherwise we would know exactly what was going to happen. But I think you need to plan longer term and put strategies in place that make your company stronger now and viable to sustain sort of the winter, if you will, that would be inevitably coming. So right now I'd say we're in the later summer months, you know, probably in the getting towards fall. We're nowhere near winter, but I think it always makes sense just to plan for that. So with that, I just wanted to thank everybody for tuning in and listening to Gary and myself, and we really appreciate that. Thank you.
Thank you.
Emily,
All
would
right.
you like to take over?
Yeah, so we have a couple of minutes left for some questions. I'm going to kick us off with our first question. How will the Trump administration affect the Fed and influence monetary policy?
Yeah, I'll take that question. I think that the Fed is an independent body, really is what, but there's no question that administrative policies have an influence on the Fed and what their direction is. This year, we're looking at about 3 interest rate hikes. I personally think that the likelihood of getting more than just 1 interest rate hike is probably higher than we've had in previous years. And I think that's based on the foundation that we laid down in 2016. Meaning that the economic expansion has been broader based. We've seen more middle class participation. So I think that we can get more than 1 interest rate hike. But I don't think the policies of the administration are going to have a big influence on the Fed and the direction of monetary policy this year. I think if you look at it, and if you were to speak to any Fed chairman or any member of the Fed, I think, you know, if you're speaking to them one-on-one, it's really going to be what the economy is going to do this year has really been baked in already. Like I said, the tax cuts are going to have more of an impact on the outer years, and it's going to drop to the bottom line in earnings per share, and that's why the stock market can perform well. We're not even talking about revenue growth there on that side of things. So I think the Fed is remaining an independent body, and the policies of the administration will have little impact on the Fed this year alone.
Great, thank you. And that actually brings us right to the top of the hour here, so I think we'll wrap up. Thank you, Gary and John, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive that credit. And you can download this now from the slide deck and handouts icon at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer to download a copy of this now. I'll leave the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it at the moment. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us this morning, and we hope you'll join us again next time.